This is the World Financial Report podcast. My name is Randy Marshall. Joining us is our financial and diamond expert, Harold Siegel. Our date is January 25th, 2018. Our time is 8:18. You can speak with Harold about investing in hard assets, diamonds, gold, silver. 1-800-432-1022. Harold's website is rarecoloreddiamonds.com. The U.S. dollar, as we start today's program, and this really is the big news of the week, it is at 88.75. We'll talk more about that here in a minute. Canadian dollar, 81.23. Gold at 13.55. Silver, 17.50. Gold-silver ratio, 77.5. Platinum is currently at $1,015. Palladium, $1,087. WTI, 66.20. Brent, 70.90. Nat gas, 353. Bitcoin, in US dollars, 11,200, and Bitcoin Canadian, $13,785. Big story, the US dollar. The White House declares open season on the dollar in Davos. Whether or not the White House choreographed the dollar slide to its lowest level in 3 years, the U.S. administration is certainly providing ammunition for those betting that the greenback will continue to weaken. The U.S. currency is caught in the rhetoric crosshairs after the Treasury Secretary Steve Mnuchin laid out the benefits of a weaker dollar for the American economy at Davos on Wednesday. The comments came days after U.S. President Donald Trump stepped up his protectionist push by slapping tariffs on solar panels and washing machines. And subsequent remarks by Commerce Secretary Wilbur Ross that Mnuchin had not shifted America's long-standing strong dollar policy did little to slow the currency's depreciation. Now, on the oil side of things, crude broke 65, and it was as a result of a drawdown. In fact, it's at the highest it's been in 3 years. U.S. crude stockpiles fell for a 10th week in the longest stretch of declines on record. And in fact, they're saying it's at the lowest since February 2015. Demand for stored supplies in the world's biggest economy has been robust at a time of the year when it's usually weak because of refinery repairs, all against the backdrop of production curbs by OPEC, Russia, and other major suppliers. Demand is outpacing supply, according to Brian Kessens, who helps manage $16 billion in assets at Turquoise Capital Advisors. The OPEC curtailments are helping, and their compliance has been relatively strong. But Harold, here we have jawboning by the White House bringing the U.S. dollar down. We're seeing strengthening in hard assets, including oil and precious metals.
That is concerning. I'm telling you, I don't like the direction the White House is going. And again, this is, in my opinion, a perfect example of how to manipulate a market. Because in the U.S. right now, the U.S. dollar is the reserve currency of the world. It's came off of a very, very strong move. And then once Trump has been in office, the dollar has fallen. Now, it's ironic that the U.S. stock market is hitting record highs almost every week. The U.S. And the Federal Reserve has been raising interest rates in the United States. Raising interest rates strengthens the dollar. All this money coming into the United States, especially into the U.S. market, stock market, should strengthen the dollar. How in the world did the dollar fall that much in 2 days when nothing has happened in the market except for conversation? So I understand that a weaker dollar, helps promote products made within the country. I know Canada has adopted a weaker dollar policy for a long time, but now the United States is actually going to adopt, if they do this, a weaker dollar policy in the United States. It's basically going to be a race to the bottom because other countries don't want a strong currency either. So if the dollar or the US dollar is the reserve currency and all currencies are falling, what is going to be the strong currency? Believe it or not, at this point, it's the euro. The euro has increased over 3 cents in the past 2 days. So I don't have a lot of confidence in the U.S. government at this point. I certainly don't have a lot of confidence in Donald Trump. He's been not only a real embarrassment, but just don't understand what he's trying to accomplish. He's such a bully type of thing. And again, I'm very concerned about the currency, primarily because it could destroy almost all currencies. Because if the dollar is the reserve currency, if the dollar is the currency that all other currencies are traded against, and then the US dollar is falling, well, if the other countries want to adopt the same type of policy of a weaker currency, then they're just going to continue to sell their currency. There has to be one strong currency. And it appears, if it's not going to be the US dollar, then it could definitely be the euro. But oddly enough, we saw the euro drop from 180, from a high of, I think, 175, 180, all the way down to almost par with the US dollar a couple years ago. And now you're talking that the US dollar is at 88 cents and the euro is trading at 125. It's not healthy for the world economy to have currencies that are this volatile, just like in Canada, when the real estate market was as volatile as it is and as it was. That's not good for the marketplace. People's homes are where most of their net worth is. And when that market gets volatile, it hurts the everyday hardworking Canadian that has his money basically invested in his home. So I don't like the way things are going at this point, Randy. The markets don't make a lot of sense. And when you start manipulating currency markets, like obviously they're doing in the States right now, that's a bad thing. It's going to hurt the world markets in a substantial way. Now, as a result of a weaker U.S. dollar, what market will benefit from that the most, believe it or not, is gold. Even though there's no bullish news in gold at this point, and there's really no major reason why gold would have gone from, let's say, 1,100 and change to the 1,350 level that it's hit this week, nothing has really changed except the value of the U.S. dollar, and most of that was done in the last 2 days. So this move in gold has actually happened prior to the U.S. dollar falling, which is very interesting. The fact is that if the U.S. dollar continues to fall, the gold market will rally. The important number for gold is $1,380. If we get two closes in a row above 1,380, this market could take off again. Then it's going to be interesting to see what's going to happen there. Is it going to be that the government is going to be concerned that gold is taking off again, and then they're going to do what they did back in 2011, which was raise margin requirements so substantially that they purposely brought down the biggest bull market in history, which was the 11-year bull market in gold. So at this point, Randy, I don't like what's happening. I don't like when markets are manipulated. Markets should trade on their own volition. You know, the thing is that the integrity of the futures and the stock markets depends on people's perception as to whether or not they're playing on a fair playing field. My personal feeling is when I see things like that, like are happening right this second with the currency market being manipulated, we're not playing on a playing field, a fair playing field. What we're basically playing in is a crapshoot that we're going to try to guess what the government is going to do next, and then what are they going to do to the market in order for it to fall in line for what their goals are. Because you can't keep on raising interest rates and see a dollar weaken. It's an impossibility. They don't go hand in hand. Just like there's an opposite trading with the gold and the U.S. dollar. When the U.S. dollar is strong, gold is weak. When the U.S. dollar is weak, gold is strong. If the U.S. market or if the U.S. government is going to adopt a weaker dollar policy, then they've got to live with the fact that gold is going to take off again. And then they're going to have to deal with that, and we'll have to see if they manipulate the market like they did in 2011, which caused the market to drop from $1,920 in gold all the way down to $1,050 just because the government didn't like gold trading at that level. This is what we, in the investment world, this is what we have to deal with in order to try to make the right decision, in order to give that right information to our clients and listeners. So at this point here, I don't like the way the markets are trading because they're being manipulated, and that's not conducive to a fair marketplace.
In our free weekly newsletter, which you can get through Harold, connect with him at 1-800-432-1022, 1-800-432-1022, the companion to the podcast, our free weekly newsletter. Gold futures post highest close since 2016 in heavy trading. Volume soared in the future markets, and in fact the highest since August 2016 as investors got behind a rally brought on by a falling dollar. Trading more than double the daily average. And they actually go on to say gold has again started the year impressively, according to Jordan Alicio, the chief economist at Australian Bullion Company in Sydney. Higher levels of demand are being seen across the precious metal spectrum, especially in ETFs, which are seeing significant inflows. January is traditionally gold's strongest month as consumers in top buying China snap up the metal ahead of the Lunar New Year. And it will be the year of the dog, by the way. Gold ETF assets climbed to the highest since 2013. Investors are piling into exchange-traded funds backed by gold, pushing assets to the highest in more than 4 years. So you can see what's happening as a result of the US dollar going down. In fact, you have Sprott Asset Management. They actually see renewed interest in gold as stocks keep rallying. They say institutional investors are showing renewed interest in gold due to the softer US dollar. And John Embry from Sprott Asset Management, he actually came out and said that he thinks the world could see $300 silver. When the bull market in precious metals gets rolling, the gold-silver ratio, which is currently around 78-1, is going to fall precipitously. In previous booming precious metals markets, the ratio has historically fallen to 15-1, which incidentally is similar to the ratio of silver to gold in the ground, implying an upside surge that will be 5 times that of gold. Putting that into perspective, it is quite easy to foresee gold's price in the $5,000 per ounce range as reality overtakes the current fantasy in today's financial markets. In that environment, silver's price could easily exceed $300 per ounce. No wonder the powers that be are a little disturbed and are pulling out all stops in what will soon prove to be the final suppression of the price of silver. That from John Embry of Sprott Asset Management. And Harold, he was out there with us in the early days of the early 2000s, recommending gold and silver. Back when gold was $250 to $300, silver was around $380, $4. And from there, silver went to $50, gold to $19.20. And it was all done within a period of time up to 2011. And then 2011, the markets backed off, gyrated a bit, and then we find ourselves right now moving sort of in a range. But if they jawbone that US dollar down, Harold, I would say that that it means good things for precious metals and hard assets in the days ahead.
Well, it certainly does, but a lot of our investments are in US dollars. So I'm just shocked that that would be the policy of the United States, and they could literally carry it out. So, again, we'll see what the next few days bring. I do not see a U.S. dollar plummeting, that's for certain. It's got to find stability in and around this level, and we'll see what happens this weekend with the meetings, obviously, in Europe, and see where we go from there. But, again, that's the reason why you hold on to gold, because you never know when something is going to happen that is going to change the whole course of the marketplace. And it's too difficult at times for people to adjust So we've always said not to trade gold, just to buy and hold gold. And again, when markets change, like they appear to be doing at this particular point, the fact is that if that market does take off again, listen, it never should have fallen. It never should have fallen from 1900 to 1050. It was made to do that. So if the market was just left to trade on its own volition, we don't know how high gold would have gone at that point, because gold was in a massive bull market. It went from $250 to $1,900 for a reason, and that reason was a very strong reason. And now we're looking at a situation where for the last 7 years, this market has traded basically sideways within a range, while the Dow Jones went from 6,500 all the way up to 26,000. Again, the markets are really screwy. It's very difficult to buy the Dow at this point because it's so expensive. Just like, look what's happening in Bitcoin. Bitcoin went from a few $100s up to 20,000, and now it's down to 11,000. You know, fact is that there are speculators in the marketplace that really make the market work, because they're buyers and sellers that are looking to make money on geopolitical or situations within the marketplace. So the fact is that when they manipulated the gold market down to $1,050, they ruined that market for 7 years. You know, it's quite possible that before gold stopped, it could have gone to 2,000 to 2,500, but it was made to fall. And again, that's what happens when the markets get into trouble and the government can do whatever they want, step in, and all of a sudden change a market's direction just because it doesn't benefit them the way that it's going. It's a really sad situation.
We have a quote from Nomi Prinz, and she was interviewed by Greg Hunter of USAWatchdog.com. She says, "I'm buying gold. I would also be a buyer of silver because silver is a used hard asset and it's at really cheap levels right now. I would be a buyer as a percentage of my portfolio. I have done exactly what I'm telling you is a good idea to do, which is to take money from the stock market and put it into hard assets." And John Awadi, CEO of Gold Standard, said, "Gold is on the cusp of a major breakout above a long-term downtrend. If gold is able to break above 1370, you will see some major momentum on the upside and see some big money flowing into the sector. Less than 1.5% of Americans have any exposure to gold, and when you look at the massive pools of capital that are sloshing around the world, if only a small portion of that money flows into the gold sector, we will see some massive fireworks on the upside. 1370 is a very important number for gold to break above, and if that happens, we could see the surge in the price of gold to accelerate." Now, some of the other things that have caught our attention this week, and you can find them in our free weekly newsletter. Get that newsletter from Harold, the companion to the podcast, 1-800-432-1022, 1-800-432-1022. Harold's website is rarecoloreddiamonds.com. Any questions about investing in rare diamonds, gold, or silver, speak with Harold. But Goldman says risk appetite has reached extreme levels. Global stocks and U.S. Treasuries are in the throes of their most extreme start to the year ever as bullish sentiment engulfs markets, according to Goldman Sachs. Now, the bank's cross-asset measure of risk appetite around the world is the highest since it started the gauge in 1991. Euphoria is turbocharging global equities, while the 10-year U.S. government bonds are suffering their worst performance in risk-adjusted terms, according to Goldman. Now, risk appetite is at the highest level on record, which leads to the question of what future returns can be. And that is from strategist Ian Wright in a note that he wrote on Monday. Investors are enjoying the fastest global expansion since the start of the decade, strong corporate earnings growth, and stable economic data. Equities around the world have added $4 trillion this year, even as major gauges flash overbought signals, while premiums on U.S. corporate bonds are back to 2007 lows. When adjusting market moves for risk, equities have been the extreme winner. Bonds and the extreme losers so far in 2018. Now, Goldman remains overweight stocks and underweight government bonds over a 3 to 12 month horizon, citing strong global expansion and hawkish monetary trajectory. The economic outlook this year and next is better than previously anticipated, but loose financial conditions and rich asset valuations suggest investors should guard against complacency. And I think that is something, Harold, that people really have to take into account with their portfolio. You want to have an insurance policy in your portfolio of hard assets. We don't know, with some of the things that are happening in the financial markets, the euphoria, the risk appetite off the charts, we don't know how this could end. And anything potentially could happen where it could end very, very badly.
You need a hedge against things happening in the market that could offset your other investments. So if you're mostly into paper at this point here, stocks or bonds or those type of investments, you need to own something, a hard asset, that's going to be able to offset the potential losses of those investments. And again, the fact is that if the US dollar drops too much, there's big problems with that also. Most people's holdings are in US dollars. And when the US dollar drops and oil is priced in US dollars, it means that oil becomes more expensive. So the fact is that we are going to see changes in the market. Right now, we're still trading within a range. And I've said this for the last few years. Until gold closes twice above 1380, it's 1380, by the way, not 1370. If it closes 2 times in a row above 1380, we could see a literal breakout in the market. Now, we've talked about this before. You know, the pain of looking to trade a market and having to wait for a couple $100 move in order to get a confirmation that that market is now moving into a bullish stance. You know, the fact is that how many times that I've traded these markets over my 35-year career and found that you have to wait for these confirmations because the market can trick you. The market can show you, like it's doing now, that the dollar's falling, so people are going to want to jump into gold prematurely, thinking that we got a massive bull market starting in gold. But if we don't get above 1380, and that's a very important number, then this market could fizzle. So again, wait for that opportunity and continue to listen to this show, and we'll certainly tell you what we think as the proper timing to start to buy physical gold again. Don't trade paper, own the actual physical metal. That's extremely important.
It's interesting to note the Dow's 31% gain during Donald Trump's first year is the best since FDR. The 30 stock index has surged more than 31% since Trump was inaugurated, and his inauguration was actually last Saturday, the 1-year anniversary. That marks the index's best performance during the first year of a president since FDR. You've got lower taxes, less regulation, and confidence in the economy is high, said one investor. The S&P 500 has surged 23% during Trump's first year in office. Also, the stock market's valuation under Trump has grown by $6.9 trillion to $30.6 trillion. The stock market added more than $6.9 trillion in market cap since Donald Trump was elected president. That is already nearly half of what the market grew in all 8 years of the Obama administration. Trump's performance, as measured by the S&P 500, is up 23% in the year since his inauguration, much better than the 13% average of first-year performances since 1928. But usually how things go is that if you have a very booming economy, the president is very popular. Well, unfortunately for Donald Trump, that is not the case. In fact, what they're finding is, even though the economy is booming along, Americans' trust in their institutions has suffered the biggest deterioration ever since Donald Trump took over the White House. according to a survey of global attitudes compiled by the New York-based public relations firm Edelman. Among the general population, trust in U.S. institutions was measured at out of a possible 143, slumping a record 9 points compared with 2017. And Harold, that is the conundrum. And granted, Trump's 3 years away from running for re-election. But the truth is, usually when you have a booming economy, you have a popular president, and that isn't equating with Donald Trump. So it will be interesting to see here in 3 years' time, can Donald Trump get re-elected again?
You can never tell. And maybe he can actually do something that is constructive, because everything that he's done so far, and I voted for him, so, you know, I admitting to that, I'm just admitting to the fact that, you know, you have no control over obviously what he's going to do, and where we thought having a billionaire running the country was a good thing, he's just the wrong billionaire. So he's extremely unpopular. He, in my opinion, he has accomplished very little here. Even the new tax bill that he's pushing through Congress, it hasn't changed anything. My taxes won't change an iota. So I just don't see it, Randy. Again, I just don't see that he's doing a decent job, and most people are concerned as to what he's capable of doing as far as hurting the country as opposed to helping it. So it's a frightening time. There's absolutely no doubt about it. He's taking credit for the Dow going up, and he had absolutely nothing to do with that. So obviously the jury's still out. We're going to have to see what happens. I just don't have a lot of faith in him as a president. And again, it's going to be difficult for the U.S. to survive 4 years with him in office.
This is the World Financial Report podcast, and don't forget, you can listen to us on Herald's website, streaming 24/7. Subscribe to the podcast at rarecoloreddiamonds.com, rarecoloreddiamonds.com. Speak with Harold about investing in rare diamonds, and if you have any questions about the financial markets, connect with him, 1-800-432-1022, 1-800-432-1022. Ray Dalio, who is one of the most successful hedge fund managers in the world, said bonds face a big bear market, the biggest in 40 years. And he said that the bond market has slipped into a bear, and warned that a rise in yields could spark the biggest crisis for fixed income investors in almost 40 years. A 1% rise in bond yields will produce the largest bear market that we've seen since 80 to 81. We're in a bear market, he said. A treasury sell-off extended following Dalio's comments, pushing the 10-year to 2.65%, near the highest since the mid-2014s. And Dalio predicted that the Federal Reserve will tighten monetary policy faster than they have signaled, and said the economic growth is in the late stages of the cycle, but could continue to improve for another 2 years. But warning from Ray Dalio on the bond market. And it was interesting for us here in Canada. There was a report from, and I encourage you to read the full report, get it from Harold by connecting with him at 1-800-432-1022. But the title of the article is Canada's Debt Binge has Macquarie sounding the alarm on rate hikes. They believe that there may only be one more rate hike for this year in Canada, either in April or July. But they are saying that the unprecedented rise in consumer debt means the Bank of Canada's rate hiking cycle is already the most severe in 20 years, and further increases will have far graver consequences than conventional analysts show. And they're actually saying that Macquarie Capital Markets Canada, they're saying that their analysis is showing that there is a problem here. Assuming just one further rate hike, the impact would be 65% to 80% as severe as the 87 to 90 cycle, which took into account 5-year bond yields, household debt, and home buying. Canada's housing market slumped in the early 90s after the rate hike cycle and recession. The Canadian economy has experienced an unprecedented period of hyper-leveraging, according to David Doyle in a report that he wrote. And some of the things that they bring up are very valid. About 30% of nominal GDP growth has come from residential investment and auto sales over the past 3 years. This is about 50% greater than what has been experienced in prior periods. The wealth effect from rising home prices has driven nearly 40% of nominal growth in gross domestic product over the past 3 years, about 2 to 4 times the amount experienced previously when the Bank of Canada was raising interest rates. Even as this has occurred, fixed business investment and exports have struggled, limiting the ability for a virtuous domestic growth cycle to unfold. This again is in sharp contrast to similar periods in the past when these were escalating. You add in new mortgage stress tests, which will have a larger impact than estimated. The new rules in isolation are expected to reduce buyer maximum purchasing power by as much as 17%. That jumps to 23% after incorporating the rise in mortgage rates since mid-2017. A lot of our money obviously has been accrued through the appreciation of our homes, condos, and the Bank of Canada better be aware of what's happening going forward with further rate hikes or not.
Again, we talked about that, Randy, and always said that it was a foolish thing to do to raise interest rates in Canada with the problems that that we have at that particular point. One, which is the tremendous debt level that Canadians are holding at this point, and two, the real estate market. And we always wondered and was concerned why the Canadian government would raise interest rates when there was no inflation, and they knew that it would hurt the consumer, but they did it anyways. And now look at what the results are going to be. So again, the government is not the smartest people on earth. They certainly make their share of mistakes. I've been in business for 35 years in the financial business, and I've seen a lot of things. And what was happening in Canada and what's happened in the States is something that I saw happening just like the gold market back in 2000. We were one of the only analysts in the market that called this run up in gold and silver and in oil and in currencies. So again, what's happening at this particular point is very, very dangerous. It could truly hurt the U.S. and Canadian economies if they continue doing what they're doing at this point. And again, a weak dollar policy in the United States is going to end up hurting the U.S. Tremendously, because the reserve currency for the world is not supposed to be a weak currency.
Harold's website for investing in rare colored diamonds, rarecoloreddiamonds.com, rarecoloreddiamonds.com. You can speak with him personally and privately about financial, geopolitical issues, where he thinks you should be investing your money today. Look at the investment quality diamonds that he has on offer at rarecoloreddiamonds.com, 1-800-432-1022, 1-800-432-1022. And in the diamond world, there was a yellow diamond that weighed in. In fact, it was Lulo's largest. Lupica Diamond Company recovered a 43-carat yellow diamond during the week. There was another big white diamond that was found. Diamond miners can't stop finding huge stones. Fresh after finding the 5th biggest diamond in history, miner Gem Diamonds has discovered another giant stone in the mountainous kingdom of Lesotho in southern Africa. The gem unearthed is 149 carats. It's a D-color type 2A diamond at its Letseng mine. And it's interesting to note Zimbabwe may end local ownership rules on platinum and diamonds. Zimbabwe, which has the world's second biggest platinum reserves, may lift a requirement that companies mining the metal or diamonds must be at least 51% owned by black citizens of the country, and that could be changing under their president. And if that does, obviously it could mean that in Zimbabwe it opens up the door for people to go in there and do some mining of platinum and diamonds. And Harold, what are you seeing this week in the world of diamonds from your perspective?
As things continue to get more and more concerning in the world, people tend to go to hard assets and hidden assets like diamonds. Portable private wealth type of thing could be traded in other currencies. And if there is going to be a currency war, the fact is that you want to own an asset that could be sold in other currencies. Gold is traded in U.S. dollars. Oil is traded in U.S. dollars, as are stocks in the U.S. and that type of thing. But diamonds can be traded in other currencies. It's just a matter of finding auctions in those currencies, in those countries, and transacting business in that area. So, again, diamonds are unique to that type of situation, along with the fact they're very easy to handle, very easy to travel with. And the way things are in the United States right now, and so many people concerned about Trump in the White House, we've never seen more people leaving the country, giving up their passports. It's called expatriating and leaving to other countries. It's hard to leave with all of your cash or stocks or gold or whatever, but diamonds, and I'm not saying smuggling diamonds, I'm saying owning diamonds, having the paperwork to own diamonds, you could travel with them anywhere. So fact is that as things continue to get more volatile and more concerning in the world economies, diamonds become much more of a visible asset at this time.
There's a couple of stories wanted to touch on, and both Harold and I were struggling with a cold flu bug here a few weeks back, and it was interesting to note there was a map that showed that the flu was a concern throughout all of North America. Usually they have different colors for different levels of concern in areas. Well, guess what? It was all the same throughout North America, severe. The flu may be spread just by breathing, according to a new study. Until now, most people thought you caught the flu after being exposed to droplets from an infected person's coughs or sneezes, but by touching contaminated surfaces. But a new study in the proceeds of the National Academy of Sciences reveal that we may pass the flu to others just by breathing, which is scary. The study, which included researchers who are now working at San Jose State University and UC Berkeley, offer new evidence on the importance of the flu's airborne qualities and how it can easily be transmitted to others. Researchers found large quantities of infectious viruses in the breath exhaled by those suffering from the flu. The study findings suggest that keeping surfaces clean, washing our hands all the time, and avoiding people who are coughing does not provide complete protection from getting the flu. Now, Cheryl Ehrman, who is now the Dean of the College of Engineering at San Jose State University, said in a statement, "Staying home and out of public spaces could make a difference in the spread of the influenza virus." But Harold, it's sort of scary because we remember doing our show and there was SARS, the bird flu, and there were other concerns about flus. And when you hear a report like this, it really does get you very concerned about if we had a scenario where the flu came in, as was the case with this tsunami warning off the coast of British Columbia and Alaska. What would we do in a panicked moment? I don't think we're personally prepared.
No, we're not. And we all had it in different levels. I know I had the flu. It was not just a cold or a cough. Here in South Florida, yesterday, a 12-year-old boy, very healthy. His parents thought he had a bit of a cold. He went out that weekend, went to a party, went to the South Florida Fair, came back with a bit of a temperature, but by the end of the night, the temperature was gone. Next morning, the poor kid was dead. Here's a very healthy 12-year-old. There's been over 30 children that have been killed by this flu. Again, I'm still fighting it from over a month ago. So it's been a terrible thing. And yes, you're right, Randy. The fact is that if they're finding that this flu or this strain of flu is transmitted just by breathing air, I mean, that is the worst possible case scenario. So again, it's frightening to think that this is happening at this point. The the needle or the shot that you get for flu this year is only 10 or 20% effective for this particular strain of flu. So it's been a terrible year. We've been fighting it for a month now, but there's been 30 kids that have died as a result of it, and it's been one of the worst flu seasons we've ever seen. And it's not just contained to one small area; it's substantial, Randy. It's a bad thing. I know that I still haven't recovered from it.
And I'm coughing too. I have friends that are still coughing months after the fact that we've had the flu or a cold. And it says to me things are changing when it comes to viruses, and it's very concerning. It's one of those things that does not get talked about a ton, or what the possible ramifications are for the future. Now, some good news as we end today's program. Congratulations to Harold's New England Patriots. Tom Brady and the boys pulled out a win at the end. Big win over Jacksonville. Want tickets to see Tom Brady win his 6th Super Bowl ring or the Philadelphia Eagles their first title? Your wallet will take a linebacker-sized hit. The cheapest tickets on the resale market at this point for the Patriots-Eagles Super Bowl is about $4,370, according to Ticket IQ. Now, if Minnesota could have been in the game because they're hosting it, the tickets could have been substantially more. But the average resale ticket price was just about $6,000 for last year's Falcons and Patriots Super Bowl game. But I would imagine, Harold, as your team they're in their 10th Super Bowl, goes for Super Bowl number 6, the prices could get rather lofty to go see them because you're seeing history in the making. I always remember watching, as a Packer fan, watching a Packers game on TV, and Troy Aikman was a color commentator, and he said, every time we see Brett Favre play, we're watching history. And I think people have to understand, every time we're seeing Brady and Belichick and the Patriots play, whether it be Super Bowls or not, you're watching history in the making, and you will tell your children about this or grandchildren many, many years down the line. And the way things are, Harold, it's hard to argue that Brady and Belichick are not the greatest of all time.
Tom Brady played in Michigan. I lived in Toronto. So really the only U.S. college football team that I did follow was Michigan. And I just became a Belichick, Brady, and Patriots fan about 18 years ago. So we've been treated to some of the best sports ever. And it's almost like growing up to be back in the 60s and 70s being a Montreal Canadiens fan type of thing, because your team was always in the playoffs. So fact is that it surprises me that in February they're having the Super Bowl, the biggest sporting event in the world, in Minneapolis. Now, it's an indoor stadium, so, the people aren't going to be in the freezing cold. The concern to me would be people traveling to get there. It's extremely cold. You get these huge storms. I would think that would be one of the last places that they would hold a Super Bowl, would be in Minnesota in February, because of the difficulty of people getting there, flying in and out type of thing. But anyways, I'm ecstatic that my team is in the playoffs, that is in the Super Bowl, and I've got my fingers crossed for Brady to win his 6th Super Bowl ring. It would be sensational.
Should be one heck of a game. Thank you for another great podcast, Harold, and for your knowledge.
It's my pleasure, Randy. I wish everybody a wonderful weekend and a very profitable day.
If you'd like to speak with Harold about investing in hard assets, rare colored diamonds, his website, rarecoloreddiamonds.com, 1-800-432-1022, our top story of the week. White House declares open season on the dollar at Davos. They are jawboning the dollar down. Trump, Treasury Secretary Steve Mnuchin, and Commerce Secretary Wilbur Ross bringing the dollar down. What will that mean? If you'd like to find out more, speak with Harold, listen to our podcasts of the future. We'll be on top of it as we go forward. Harold's website, rarecoloreddiamonds.com. Connect with him personally and privately, 1-800-432-1022. That's it. The World Financial Report podcast with Randy Marshall and Harold Siegel. We will talk to you next week.